Imagine for a moment a huge global company, like a real empire of businesses with subsidiaries, all over the world.
Right. Sprawling structures.
Exactly. Now, picture one of those subsidiaries, a whole functioning business unit getting transferred, moved from one part of the empire to another.
Okay.
Still owned by the same ultimate parent company, just reporting up a different internal chain. You'd probably think accounting for that is simple, right?
Yeah. Sounds like just moving numbers around internally.
That's what you'd think. But believe it or not, this exact scenario has been a massive puzzle for global financial standard setters for, well, decades. It led to this big hole in the accounting rulebook.
It's definitely one of those things that seems simple at first glance, but when you dig in, it opens up this really fascinating and often kind of ignored area of financial reporting.
And that's precisely where we're diving in today. We're tackling something called business combinations under common control, or BCUCCs for short.
BCUCCs.
Got it. Yeah, and it's not just accounting jargon, honestly. It gives you a real window into how complex it is to track assets and liabilities inside these massive corporate groups. What's really grabbed me is that for years, the main global system, IFRS, International Financial Reporting Standards, just had this acknowledged gap.
A blind spot.
Totally. IFRS 3, which is the go-to standard for most company mergers and acquisitions, specifically excluded these common control deals.
And that exclusion, well, it didn't exactly lead to smooth sailing, did it?
Not at all. Like you said, it kind of created a bit of a wild west. Different companies did things differently, lots of questions about transparency, a real foundational gap.
Created a lot of headaches, I bet.
Oh, for sure. So our mission today is to unpack this. Why was there a gap? What did the standard setters, the IASB, try to do about it? And here's the really interesting part. Why, after all that work, did they decide not to create a specific global standard?
Right, that's the surprising twist.
It really is. And it tells us a lot about how these global rules actually get made, or sometimes don't get made, and what that means for you if you want to understand what's really going on in a company's financial reports.
So maybe we should start with the basics. What exactly is a BCUCC, a business combination under common control?
Good idea. Lay it out for us.
Okay, think of it like this. You've got a big company group. A business, not just assets, but a functioning business, gets transferred from one company in the group to another.
Like shuffling departments, almost.
Sort of, but it has to be a whole business. And the key thing is, the same party controls everything before the transfer and after the transfer.
Okay, so the ultimate owner doesn't change.
Exactly. And that control has to be stable, not just some quick temporary thing. It can't be transitory, as the jargon goes.
So it's a real lasting restructure within the same family, basically. Can you give us a concrete example?
Sure. Let's say you have holding company P. P owns subsidiary A and subsidiary B. Subsidiary A owns another company, company C, which is an active business.
Right.
Now, company C gets moved so that subsidiary B owns it instead of subsidiary A. Company P still controls everything ultimately. That transfer of C from A to B, that's a classic BCUCC.
Okay, that makes sense. Moving a business between siblings, all owned by the same parent.
Precisely. Happens a lot in group restructurings, or when one subsidiary maybe acquires a business line from another one within the group.
Got it. But if it's all in the family, why the accounting headache? Why couldn't IFRS 3, the standard for buying other companies, just handle this?
That's the million-dollar question, isn't it? And this gap, it's not new. IFRS standards, especially IFRS 3, have just never covered BCUCCs directly.
Never.
Nope. The exclusion actually goes way back to the standard before IFRS 3 called IAS 22. We're talking 1983.
Wow. So for decades, this specific type of transaction just fell through the cracks of global standards.
Pretty much. It's like these internal family deals were seen as different, maybe less critical for a single global rule.
But companies still had to account for them, right? They couldn't just ignore these transfers on their books.
Absolutely not. So when there's no specific IFRS rule, companies fall back on another standard, IAS 8.
IAS 8, what does that do?
It basically tells companies how to develop their own accounting policies when a specific standard is missing. They have to use judgment, look at the IFRS framework, look at similar standards.
Ah, so they have to make their own rules, essentially, using judgment.
Exactly. And that's where the chaos you mentioned earlier really started.
Right, because judgment can mean different things to different people, especially in different companies or countries.
Precisely. You ended up with identical or very similar internal transfers being reported in completely different ways.
So for you listening, trying to compare, say, company X and company Y, after they both did similar internal restructures, it could be almost impossible.
It could be incredibly difficult. Some companies might use the acquisition method, treating it like buying an external company,
Which means?
measuring everything at fair value, recognizing goodwill, the whole 9 yards, like a normal acquisition.
Okay. And the alternative?
Others would use various types of book value methods. Essentially, they just carry over the existing asset and liability values from the transferring company's books. No revaluation, no new goodwill.
That sounds fundamentally different.
It is. And adding to the confusion, companies often didn't disclose much detail about which method they used or why, or even the impact. Transparency was often quite poor.
I can see how that's a massive headache, not just for investors, but who else felt the pain?
Oh, everyone involved in the financial reporting chain. The companies preparing the accounts spent time figuring out and justifying their approach. Auditors had to spend extra time scrutinizing these judgments.
And regulators.
Them too, trying to ensure some level of consistency or fairness without clear rules. It just created a lot of extra work, cost, and debate. Inefficiency, really.
Okay, so the problem was clear. A long-standing gap, diverse practices, lack of transparency, extra costs. The IASB, the International Standard Setters, they saw this, right?
They did. They acknowledged the problem and launched a project specifically to address BCUCCs. They even put out a discussion paper back in November 2020.
Trying to finally fill that gap, what was their thinking? What kind of solution did they propose?
Well, what's really interesting is they came out quite clearly saying, look, one size probably doesn't fit all here.
Okay, a nuanced approach. I like that.
Yeah, it acknowledged the different circumstances. So their preliminary idea was essentially a two-pronged approach.
All right, let's hear it. Prong one.
Prong one was for BCUCCs happening at a subsidiary level, where that subsidiary also had outside owners, what we call non-controlling shareholders, or NCS.
So minority investors who aren't the main parent company.
Exactly. If those shareholders exist in the company receiving the transferred business, the IASB suggested using the acquisition method, mostly.
Ah, so treat it like a real acquisition from the perspective of those outside owners.
Precisely. Measure the incoming assets and liabilities at fair value, recognize goodwill. The logic was that for those external shareholders, it is effectively an acquisition changing their investment.
Okay, that makes intuitive sense. Protect the minority view. So, fair value and goodwill if outsiders are involved. What was prong two?
Prong two covered all other cases. So any transfer where the receiving company didn't have non-controlling shareholders, basically, purely internal group shuffles.
And for those?
For those, the IASB proposed requiring a book value method.
Meaning, just carry over the existing numbers.
Essentially, yes. Use the existing carrying amounts of the assets and liabilities from the transferring entity's books. And crucially, no new goodwill would be recognized.
Okay, so let's spell out the key differences again. If you were looking at the financial statements, how would these two methods make the transaction look different?
Hugely different. Acquisition method. Assets and liabilities remeasured to fair value. Potential for new goodwill to pop up on the balance sheet. No restatement of past numbers usually.
Got it. And book value.
Book value method. Assets and liabilities stay at their existing carrying values. Absolutely no new goodwill created by the transfer itself. And often you'd have to restate past comparative periods as if the transfer had always been in place.
Wow, yeah. Very different pictures. So the IASB hoped this dual approach would finally bring some clarity and consistency.
That was the goal. Better information, more transparency, improved comparability, especially for listed companies where lots of investors are looking closely. They thought this would solve that long-running problem.
Okay, makes sense. Problem identified, plausible solution proposed. Which leads us to the really fascinating part. Because despite all this, in November 2023, the IASB decided to stop. They shelved the project, didn't create a new standard.
Yeah, quite the plot twist, wasn't it?
It really was. When you've got a clear gap, a proposed fix, why pull the plug? What went wrong? Or what was the reasoning?
Well, it boils down to a few key things,
Okay.
mostly coming from the feedback they got on their proposals. First, stakeholders were just deeply divided.
Stakeholders meaning?
Users of financial statements, companies preparing them, auditors, regulators, even the IASB's own advisory groups. There was no consensus on whether a new standard was even needed, let alone what it should look like. Views were all over the place.
So just fundamental disagreement. But what about the users, the investors and analysts? Weren't they clamoring for clearer information?
You'd think so, but surprisingly, a lot of the feedback suggested many users actually weren't that bothered by the existing diversity in BCUCC reporting.
Seriously, they weren't bothered.
Some even called the project unimportant,
Hmm.
which is pretty striking feedback for a standard-setting body to hear.
Unimportant. How could standardizing these potentially large transfers be unimportant? What was behind that?
It seems user needs vary dramatically by region. For instance, users in China, where BCUCCs happen a lot, almost universally said, just use book value always, full stop. But users in many other parts of the world tended to prefer the acquisition method, at least when those non-controlling interests were involved. So trying to create one global rule that satisfied both camps, really, really difficult.
A global standard needs global buy-in, which just wasn't there.
Exactly. And there was another practical point, too. The IASB did a big review of actual company practices.
What did they find?
They looked at nearly 270 BCUCCs and found that, in practice, companies were already using some form of book value accounting in about 94% of cases.
94%. So even though there was diversity in how they applied book value methods, the vast majority were already avoiding the acquisition method.
That's right. It suggested the problem of diversity might have been more about the details within book value accounting, rather than a fundamental split between book value and acquisition methods in most common scenarios. The practice was already leaning heavily one way.
So putting all that together, split views, users saying meh, and existing practice already leaning towards book value, sounds like the IASB did a cost-benefit analysis.
That's exactly what they said. They concluded that the potential benefits of forcing a change through a new standard were likely outweighed by the costs.
Costs like?
Costs for the IASB to develop the final standard, costs for companies and auditors to implement changes to systems and processes, costs for regulators to enforce it. Given the mixed demand and existing practice, the overall value proposition just didn't seem strong enough.
Okay, I can see the logic, even if it's a bit surprising. But what about a simpler solution? Did they consider just requiring better disclosure about these deals, even if the accounting varied?
They did look at that, yeah, a disclosure-only approach, but they rejected that too.
Why? More disclosure usually seems like a good thing.
Their reasoning was that existing general IFRS disclosure requirements already technically apply to BCUCCs. Things like explaining significant transactions and accounting policies. They felt that creating specific new disclosure rules just for BCUCCs wouldn't add enough value to justify the cost and effort of that separate project either. The existing toolkit was deemed sufficient, more or less.
So the gap remains. What does this mean, practically speaking, for us, for you, the listener, trying to understand company financials?
Well, the most direct result is that the diversity continues. Companies reporting under IFRS will still need to use their judgment, guided by IAS 8, to pick an accounting policy for BCUCCs.
So we'll keep seeing different approaches.
Yes, you'll still see some using book value methods, maybe variations of them, and potentially some using the acquisition method in certain situations, though likely less common based on that study. Comparability remains a challenge.
But maybe less of a challenge within certain countries if they have their own local rules.
That's a fair point. Some jurisdictions do have specific local rules that might enforce one method, reducing diversity within that country. But if you're comparing companies across borders or looking at a multinational group with subsidiaries reporting under different local interpretations, you still have that global comparability issue. You need to be aware.
This whole saga is actually a fascinating case study in standard setting itself, isn't it?
Oh, absolutely. It really highlights the real-world friction. It's not enough to just spot a technical inconsistency in the rules.
Right.
You have to balance incredibly diverse views from around the world, weigh up real costs against perceived benefits, and critically figure out if a new standard will actually be seen as useful and necessary by the people using the financial statements.
And sometimes, even with a clear technical gap, the practical answer is, maybe we don't need a new global rule right now.
Exactly. Sometimes the hurdles to global consensus are just too high, or the perceived benefit too low compared to the disruption.
So even though the IASB stepped back, these BCUCC transactions are still happening. The underlying complexity hasn't vanished.
Not at all.
Which means, for anyone analyzing financials, you still need to keep a close eye out. You need to scrutinize the notes, understand the accounting policies used for these internal transfers, and figure out how they might be impacting the numbers you see. It puts more onus on the analyst, really.
It certainly does. The lack of a standard means more digging is required.
Yeah. So we started this deep dive with what seemed like a simple question. How do you account for moving a business inside a big company group? And we found this long-standing gap in global accounting rules.
Decades old.
We saw the IASB try to tackle it with a thoughtful two-part solution, but then the twist, they ultimately decided not to issue a standard.
Not because the problem wasn't real, but because the feedback was so divided, many users didn't see it as critical, and the practical costs seemed to outweigh the benefits of forcing a global change.
It's a powerful reminder, isn't it, that even in the superstructured world of accounting rules, things like judgment, local customs, and even perceived unimportance can stop a universal standard in its tracks.
It really shows the limits of global harmonization sometimes. So the next time you're looking at the accounts of a large, complex group, maybe pause and think about those internal shuffles. Consider the judgment calls hiding beneath the surface and how a decision not to standardize might be shaping the financial picture just as much as any new rule. Makes you wonder, doesn't it, how much transparency do we truly have, and what might we be missing when there isn't one clear global way to account for something?